you're getting on this VC track, you're going to continue to raise more VC money, and you're going to get diluted as it goes down, and you want to make sure that you as the founding team continue to hold the majority of the business for hopefully as long as possible. How many people in this room are entrepreneurs or want to be entrepreneurs at some point? Oh, good, great, okay. So one thing I wanted to say about venture capital, because I think it's something that doesn't get said enough, is that too many times people think, okay, I start my business, and then I'm going to go out and I'm going to raise venture capital money, and then I'm going to grow the business. And I know I may happen to be in the industry, but venture capital isn't necessarily the best way to build your business, right? And I think that, again, like, so many people are like, hey, you know, I mean, I was talking to somebody today about this. I'm like, these people, they think that, hey, you raise venture capital money, you've got to the finish line. No. You're just at the start line for a really fast race. So I think that if you want to raise venture capital money, that's great, but you need to understand what that means. And if you raise venture capital money, when a venture capitalist invests in your business, they are only investing because they want a tenfold increase in their money. And their expectation is that you're going to run hard, and you're going to go out, and you're going to spend your money, and you're going to raise another round, probably in 18 to 24 months. And the expectation is that you're going to raise that round at 3 times the valuation that your last round was. And then you're going to grow really quickly, and you're going to spend a lot of money. And then in another maybe 2 years, you're going to raise more money, again at 3 times that valuation, and then you're going to keep going. And VCs, the whole venture capital business is based on, we know that 50% or so of our businesses are going to fail, but that's okay because we're going to make it up on the other ones. And for some people, that's fantastic. You've got a great business, you want to take it to the moon, you want to build a great business, you want to get pushed hard. That's great. I mean, those are the people who I work with every day, and I love it, right? But there's also, but it's not the only way to grow a business, right? There's other ways. I mean, I have a lot of friends I have a very good friend who has a very successful business. He grew it himself. He has about 30 people. He's self-financed, and he owns the whole business. And is it huge? As big, maybe as if he got VC money? Probably not. But he's happy, and he's successful, and I think that was a route that he wanted to go because he wanted to control his destiny. He didn't want to have a venture capitalist in his business. So again, I'm not bad-mouthing the venture capital world. I happen to love it. I think that VCs add a ton of value. Of course I do. But as I said, I think it's a point of view that doesn't get presented enough, and I think it hurts entrepreneurs who think that the only path to success is to raise VC money. And what I'm trying to say is, hey, that's not necessarily the way. And you need to, before you decide to take VC money or to go down that route, you need to understand what's involved and the expectations that you're going to run basically as hard as you can, and you're either going to be successful or you're going to hit a wall. It's like, as one of our partners says, he says, it's like, if you take VC money, you need to understand you're running for the cliff, and you're going to jump off the cliff and figure out how the parachute works on the way down. Like, it's like that's the way it is, right? And so, as I said, if you want to go down that path, great, but you should think about other options as well. Basically, these sort of 2 big buckets. One is, do we think this could be a big idea? Right? And so, I mean, there's sort of lots of little sub-points under there, but it's basically, is this a huge idea? So, you know, is the size of the market and the competition and the competitive advantage and all that sort of stuff? And then the other side is the team. And so we invest, probably 50% of the companies that we invest in, because we do early stage, are people who are right out of university or right out of college. So we're really looking for people who are passionate about their ideas, who are willing to work hard, who will stick with it through the ups and downs. And if there's typically a team, and so how does the team work together as a unit? Are they complementary? say, first of all, like, we'll look at anything, because you never know, and often the biggest businesses, like, I don't think anybody would have, before Facebook came along, did anybody say, hey, I really want to invest in a social media network? Or before Google, did anybody say, hey, I want to invest in a search engine? So we're always sort of open. But that being said, I think a couple of the key trends that we're excited about is artificial intelligence and machine learning. And computing power is now getting much stronger, and the technology is getting much stronger, that we're seeing this AI and machine learning being embedded in all businesses. And what I mean by that in terms of machine learning and AI, it's like, it could be any business that leverages information. I mean, actually, Facebook mentioned Facebook. Like, they have some of the best machine learning and artificial intelligence people in the world. So, I mean, just to be clear, like, it basically, when you go to Facebook and your feed, like, it knows what you clicked on before, what you read, what other people read, and so it serves your feed dynamically based upon a huge number of variables. Right? So that's an example where people wouldn't necessarily say, hey, that's an AI business, but it is leveraging that. And so, I think most businesses today should be thinking about, hey, this is the next wave that's going to affect everything. It's like, way back when, and people said, hey, you know what? Hey, an internet business. Well, I would argue every business today is an internet business to some extent, right? And then it was like, oh, mobile. Mobile is the next thing. We want to invest in mobile technology. Well, most businesses are mobile to some extent, right? And I think that's the same way to think about AI and machine learning. The most important thing is make sure it's a long-term relationship with your VC. So make sure that that you like them. I mean, that seems sort of weak, but the bottom line is you got to like them, right? You got to trust them. You got to believe that they're your partner. But I would say, so when you do your first raise in terms of like what's called the seed round, typically what we advise companies is you never give away more than 20% of your equity. So just so that everybody's on the same page in terms of how it works, is let's say a company goes out and raises $1 million, which is quite a bit of money for a seed round, but I'm just using that to make the numbers easy. And then you say it's a $4 million pre, which means that the business, before you took in the $1 million, you're saying this business is worth $4 million. And then you take in $1 million cash. So then the day after your fundraising closes, you had your business, which was worth $4 million. Then you have $1 million in the bank. So your business is now worth $5 million, right? So that's why you have, hey, it's a $4 million pre, $5 million post on a $1 million raise. And so then you would say, okay, that VC, they put in $1 million. So they basically, of the $5 million value, 1 over 5, 20%, they own 20% of the company. What we generally advise entrepreneurs is never give away more than 20% of your company in the first round. I try to have it closer to, 15%. Because, again, if you're getting on this VC track, you're going to continue to raise more VC money, and you're going to get diluted as it goes down, and you want to make sure that you, as the founding team, continue to hold the majority of the business for hopefully as long as possible. We also, when we invest, is we think the founders should retain ownership of the board for ideally as long as possible. Now, if you get way down to so that just, again, for terminology, there's a seed round, and then the next round is Series A, and then goes Series B, Series D, keeps on going. So maybe if you keep on going, maybe you're a Series D. Okay, maybe by then, the entrepreneurs need to give up the majority of the control. But I think the key things are, in your seed round, try not to give away more than, or don't give away more than 20%. Make sure you retain control of the board. Make sure that they don't have control over things like when you raise money, how much money you raise, things like that. The other thing is, typically when you get a VC to invest, they will make the founders do something called reverse vesting. So basically what it means is, let's say, I'll just make things simple. You own your company, right? You go and you get your VC money, and as I explained before, then your VC owns 20%, and you own 80%. Now, what the VC will do is they'll say, well, wait a minute. I don't want you to leave the next day because I'm really putting my money in because you're in. and I've just put, again, using the same example, I just wrote you $1 million check, and then you're going to turn around and leave this company. Well, I'll still own 20% of this company, but you'll own 80%, and the company's going to fall apart, and I've just put them, like, this doesn't work. So what they'll say is, again, it's sort of negotiated, but the typical might say, hey, you're 80%, you actually only own 20, you sort of own 80%, but it's going to vest over time. Which means that if you leave tomorrow, maybe 25%, so 20% of the total, you own today. And if you leave the company today, you only take away 20%, because the VC will say that other portion, right, the 60%, the 80% minus 20%, I got to use that to go out and hire a new CEO who's going to run this company, right? And so basically, it's a tool to make sure that the founders stay with the company. Okay, so if you're a founder and you're like, well, of course I'm going to stay with the company, that's fine. But it's a consideration, but that's why it's done. But typically, there's two co-founders. So then you say, hey, there's two co-founders, so they both vest, which actually helps things. Because what you don't want to get into a situation, if you're a founder, your co-founder walks out the next day and takes, again, let's use the same example. So it's 80%, you each own 40%. And let's say 2 months in, your co-founder says, hey, actually, you know what, I'm out of here. I got a high-paying job somewhere else. And he walks away, and he still owns the same portion of the company as you. And you're the one who's working hard, making no money, building this company. He owns just as much as you. Like, that's bad, right? So that's the way it's sort of built. Think about it in two categories. One is the hard skills, and the other is the soft skills. And so what I mean by that is in terms of, okay, typically in a small team, you need one person who's technical and one person who's business, right? And then then you can hire around that. But if you have, you have a really good technology, and then you have a good business person who can figure out how are we going to get to market, how are we going to sell, can go out and talk to customers and sell, and then hopefully, maybe often that person does the bookkeeping and the financial projections, and often that person's the key person to talk to investors. Then really, those two people, often we see just two people, and then maybe they hire a third person as a developer, or maybe often the third person is a developer, and then it sort of grows like that. But I would say complement your skills, and then on the soft side, it's really about people who you can work together, right? And it's like you need to think, hey, how would if you're part of the team, how would I feel about being locked in a room for 24 hours with this person? Like, would we be like that would be good, or would it not be so good, right? And so, because ultimately you're going to go through a lot, and so do you support each other? Do you have the same values? Do you work well as a team together? I came back to Toronto because I love Toronto. I love Canada. My family is here, and this is where I wanted to have a family. That being said, in a short answer, that's why. I mean, again, I talk about, following your passion, understanding in your heart what's important to you. And what was important to me was to be here, to be in Canada, to be in Toronto. That being said, I get asked a lot, and I don't know if this is where your question was heading. A lot of entrepreneurs are like, hey, what are the pros and cons, and what about starting a business in Toronto versus in Silicon Valley? And this is an answer that I wouldn't have said 10 or 15 years ago, but I will say that I think Toronto is as good, if not better, a place to start a business than in Silicon Valley right now. There's a huge, vibrant ecosystem here. There's all sorts of accelerators. There is very good quality engineering talent here. And by the way, that talent is a heck of a lot cheaper and more loyal and more willing to stick it out and for your company than in Silicon Valley. And there's government programs here, there's tax credit programs, there's so many reasons why this country is great, and I really feel that we're on a tipping point of really making things happen. And I know that it's not just me here preaching about how great Canada is. I mean, I talk to US Valley-based VCs all the time who are coming up to Canada, who are saying we're looking for Canadian companies to invest in because we know that there are great entrepreneurs here. I talk to my friends who are entrepreneurs and CEOs of startup companies in Silicon Valley, and they're like, Janet, this talent down here, they have no loyalty. As soon as they think they can make more money somewhere else, they're going to jump ship. But we don't have, I look at the turnover I know the turnover numbers of startups in Toronto, and I know what they are in the Valley. The turnover is much lower here. There's much stronger loyalty. So there's lots of reasons, and I would say to anybody who's starting a business here in Toronto, be proud that you're in Toronto and never feel that you're second rate to anybody in Silicon Valley, because we've got a lot going for us.